Hello there, welcome to a new video. In this particular presentation, we are going to talk about the actual market reaction price patterns. Okay, basically the price patterns we are going to base our entries. Okay, it's finally time for us to take trades, and that's exactly what we are going to be reviewing over the following minutes. Now, those price patterns are going to be related to candlestick formations. You may be familiar with candlestick formations in themselves already. However, please bear with me as I go through a little bit the basics, okay, or at least my understanding of candlestick formations, and then we can move on to the actual trading examples, okay, actual trading patterns we are going to be basing our trading decisions on. Now, there are a number of points we are going to cover in this video, such as the definition, the significance, location, time frame, direction, and the types of formations finally. Alright, we're going to go through all these different points one by one, so just to make sure we are all on the same page here. Alright, as I always say, first things come first, so let's get started with the actual definition of a candlestick. Alright, as you probably know, we can plot our forex charts for any particular currency per, let's assume, on the daily time frame, for example. Well, we can plot our charts using the line chart, alright, which basically tracks the close values of each particular time segment, again, 24 hours worth of price action. Since we are in the daily time frame, we simply mark, or our charting platform simply marks the close value of each particular day, and then linking them up, we finally get the line chart. Then we have the bar chart, in which we get a little bit more of information, actually quite more of information. That will be the open of the day, the left wick of that bar. The right wick gives us the close value of that particular day. As you can see, this has been an up day. Okay, price has been trending up within the trading session since the open value is lower than the close value, and then the upper and lower wicks gives us respectively the high and the low point for that particular day. We get exactly the same information if we use the candle chart. All right, the only difference is that we get some type of a color code in that candle. If it's a green candle, it's obviously been an up day. If it's been a down day, our charting platform will color that particular candle in red. If it's an up day, our charting platform will color this particular candle in green, and therefore that's the open, that's the close, that's the high, and that's the low. All right. If it's been a down day, pretty much the same thing, but the other way around. The color of the candle will be in red, and therefore that will be the open for the day, that will be the close, that will be the low, and that will be the high. Now, like I said before, you are probably familiar with this. I'm not going to spend any more time, going back into such a basic information. All right, so let's get moving with the formations in themselves. We are from now on going to be talking about candlesticks, and now it's time to define what those formations actually are. Well, a formation is a combination of different consecutive candlesticks, all right, that shape up in one particular way. Okay, and that combination as a whole, all right, the entire combination of different candlesticks are going to give us one particular price patterns, and we are going to be able to extract some extra market information depending on the way those particular consecutive candles shape up. All right. Some of them are going to be continuation patterns, some of them are going to be reversal patterns. That's exactly what we are going to be covering from now on. Now, such combinations of different formations usually take up from 1 to 3 individual candlesticks each. All right. Again, a formation can take up from 1 to 3. Individual candlesticks. Any more than 3 is a little bit overcomplicated. All right, it's just taking too much information at once. The more you complicate things, usually it's actually counterproductive as far as trading is concerned. I am a firm firm believer of keeping things simple, so we are going to only study combinations taking up 1, 2, or 3 different candles or individual candles. Now, why do we care about candlestick formations? Okay, basically, why are they significant to us? Well, the thing is that candlestick formations is price action reading in its finest form, okay, in its purest form. At the end of the day, please mind that our trading decisions are going to be completely based on the formations in themselves, on the chart reading skills, on our chart reading skills as traders, and therefore we are not going to be using any type of indicator. We are not going to be zooming to the shorter time frames, none of that. Okay, we're just going to be reading the individual candles in themselves and the combinations of those individual candles, and as a result we are going to extract enough information to take a trading decision. All right, if I was to use any type of analogy, well, I would say that candlestick formations are like the fingerprints of chart reading in itself. Are the little clues that the markets give us here and there, and those little clues, those little fingerprints, are useful enough to to fill us in with the information that we require in order to know when to take the trade, right? When to not take the trade, in which direction we want to trade, either to the upside or to the downside, etc., etc. Again, little clues, little fingerprints that we may find on the crime scene that are gonna put all the different pieces of the puzzle together. Now, location is really important here, guys. Going back into our previous analogy, if you were a police officer investigating any type of any crime scene, well, obviously you would consider more significant those fingerprints that you find on the actual killing weapon, the gun or the knife, whatever killing weapon the murderer may have used. Well, you would obviously consider those fingerprints more important than those fingerprints you find anywhere else in the crime scene. Right? Isn't that right? Well, obviously exactly the same thing happens whenever we are reading our charts and whenever we are to search for candlestick formations. Where in the chart those candlestick formations take place at is absolutely crucial, and you already know the answer to this. We are going to be interested only and exclusively on candlestick formations that appear around key levels of support and resistance. All right, let's assume we had a swing down, price broke through a level of resistance, and then it's coming back to retest that level from below. Well, if we get a particular candlestick formation somewhere in there, is certainly not as important, or the quality of the trading signal we get out of that price formation happening there is just not going to be as significant as if we got that same candlestick formation just around that key area of support and resistance. All right. At the end of the day, please remember, those levels of support and resistance are decision-taking levels in your chart, levels where the traders as a whole, as a community, are expecting are expecting price to retest in order to take their trading decisions, right? So any type of clue as of the upcoming market direction you may get around this area is certainly going to be way more significant than if that price formation happens anywhere else in the chart. So to wrap it up, location, we are only going to be interested in candlestick formations around or right of significant levels of support and resistance. Now, the time frame, in which time frame do you want to search for those candlestick formations? And again, you already know the answer to this. It depends on whatever time frame that particular level of support and resistance belongs to. All right, that's why I mentioned in a previous video that you want to color code your levels of support and resistance. Okay, the actual lines just for a visual reference. If it's a monthly time frame, a level of support and resistance that you draw on the monthly chart, well, you want to be searching for that particular you want to be searching for price formations once price comes to retest that particular level on the monthly time frame. If it's a weekly level of support and resistance, well, then it means that you want to search for those candlestick formations on the weekly time frame once price comes to retest that level, etc., etc. All right? Simply, you want to match that key decision taking level and that time frame, and that's where you want to search for those formations. All right? Now, finally, direction. In which direction do we want to trade? Do we want to search for buy opportunities, or do we want to sell for sell opportunities? Well, here's the shocking truth. That doesn't depend on you. I repeat that. That's not up to you to decide whether you want to be searching for long opportunities or for short opportunities. You need to wait for the market reaction. All right? The market as a whole is going to give you the directional bias. So, if we have a level of support and resistance, price is coming back to retest that level, all right? It depends on the market reaction we get around that level. Again, depending on that market reaction, you will be positioning your next trade, again, either to the, as a breakout trade or as a reversal trade. Again, depending on the candlestick formation you get of that particular level. And now, most people, and this is very important, guys, I really would like you to write down this on a piece of paper and to stick it next to your monitor, tattoo it on your forehead, whatever you want to do with it, but please, please, please pay attention to this. Most people believe, most traders believe that trading is about prediction. Most people believe that trading is about foreseeing the next market move, the next market swing, and that's absolutely incorrect. That's actually the fastest way to terminate your account. Market is not about prediction; it's about reaction. All right. You are not, as a trader, your job is not to foresee the next market move, is to simply react quickly to the move, to the swing that's already happening on your chart. All right? It's impossible to foresee the next market move. It's absolutely impossible. It doesn't matter whether you are an individual trader or you are a professional trader or you trade for the Central Bank of America. I don't care. It's absolutely impossible to determine the next market move. So your job is not to get ahead of the market, right? Your job is to wait for the market reaction and then simply trade accordingly and as quickly as possible, all right? As quickly as possible, obviously, in the direction of that market reaction. So what am I getting down to? Why am I telling you all this mambo jumbo here? Well, the thing is that once price comes back to retest that level, you should not be biased to any side. You need to wait for the combination, for the right combination, price candlestick formation to appear or to happen at that particular level. And once you get that combination, then you will be biased either to the upside as a breakout or as a reversal, not before. All right? Do never bias yourself into any given direction. Okay? That's just so important, guys. Please write down on a piece of paper. Trading is not about prediction; it's about reaction. And well, now that we've covered all these basic points, it's time to get down to the beef, okay, to the meat of candlestick formations, the different types of formations. We are going to be searching around those key levels of support and resistance in order to take our trade. So, guys, fasten your seatbelts because we are about to get started. Hello there, Hector the Bill here. In this particular video, we are going to be studying the reversal formations. All right, the type of price patterns, candlestick formations that are going to hint an upcoming reversal move. All right. Obviously, if we are going to trade a reversal, we are obviously going to locate that reversal, as you know, around a level of support and resistance, and we are going to be interested only in those reversal formations that happen around well, a level of support and resistance. As a case example, okay, just to make for the sake of discussion, well, I've located here a horizontal line which represents, again, as an example, a resistance line on the daily time frame. Now, obviously, this could be the daily, the weekly, the monthly, it doesn't matter, right? All these principles are universal across all time frames, all right? Also, it doesn't have to be a resistance, right? It could also be as they could also work as support. We would just need to place these formations instead of under the resistance line. Well, we would place them, or we would search for them above the support line. All right, and also, well, this resistance line doesn't have to be a horizontal level of support and resistance. We can also find these formations of a diagonal level of support and resistance, meaning trend lines. Also, maybe a confluence of a trend line along with a Fibonacci retracement. Okay, that being the previous swing down. Then we go. Price gives us a little bit of a pullback back to the 38, 50, and 61 Fibonacci retracements. Well, around that area, if we find any of these different reversal formations, well, that would give us, that would clue us in that the next upcoming move is going to be a reversal move into a whole new swing in the direction of the trend. At any rate, whenever we find a resistance level, all right, any support or resistance level, these are the formations that may indicate an upcoming reversal move. So, since this is a resistance, that means that price is immediately below that level, all right, maybe coming back to retest that level. If as price climbs up to retest that resistance level, well, any of these formations that we may get just below, okay, just below, because it's resistance, it would, if it was support, we would search for these formations, as I mentioned before, just above that level. So if we find any of these formations just below resistance, any resistance level, we are looking to trade a bounce. In a future video, I will explain, or I will show you guys the breakout formations. On this particular video, we are gonna just stick to reversal formations. Okay, all right, well, out of the as you can see, 5 different reversal formations we are going to be studying on this presentation, 3 of them are high quality ones and the last 2 of them are low quality ones. This doesn't mean that they are not, they are not tradable. They are indeed tradable, but you will probably see in the long run a little bit of a lower win-loss ratio out of these ones than if you just stick to these ones. Okay, again, you can trade them all right, if you trade them correctly. They are all profitable, but again, the quality signals and therefore the win-loss ratio in the long run is going to be a little bit higher of these ones, right, than just of these ones. Okay, I'm gonna go through all of them, and then, well, you decide whether you want to go for the conservative route and therefore you just trade the first 3, or the aggressive route and you simply trade them all. By the way, before I get started, just to avoid confusion, these are all individual candle formations. All right, you're not supposed to be searching for all of these, okay, at once. Just one of them. All right, this is one formation. You can either get reversal formations taking the shape of a hammer or a pin bar, which is basically the same thing, or a railway tracks, or an outside bar, etc., etc. You are not supposed to search for all of them at once. All right, I just wanted to clear that up. All right, let's get started with the first one, which is also the most prototypical one, the most common one, and the most easily recognizable one. All right, that's the hammer or the pin bar formation. A hammer is basically a one candlestick formation, okay, a combination of just one single individual bar where the body of the candle is small, and well, you have a short wick to the downside and a long wick to the upside, touching that level of resistance. If it was a level of support and price was coming down to retest that level, well, the hammer should look the other way around. All right, small body, small wick to the upside, and a long wick to the downside. Okay, This is obviously a bearish hammer, since prices, this is a reversal formation that's going to point to the downside. A bullish hammer, as I mentioned before, looks something like this, all right? And well, it hints the reversal in the opposite direction, meaning to the upside. It's also called a pin bar, and that comes from Pinocchio bar, all right? The famous Disney character. And the reason as of why it's called Pinocchio bar is because of the long nose, because it's a lying nose. All right. Basically, it indicates that price is gonna move in one direction, but rather soon, rather fast. Well, it fakes you out, because the actual direction that price is likely to take in the upcoming move is going to be in the opposite direction. Okay, that's why it's called a Pinocchio bar. Alright, well, the hammer or pin bars don't always happen right off that particular level of support and resistance. That means that they do not always touch to the pip and then they bounce sharply off that level. Sometimes the long nose, the long wick, does indeed breach through that particular level. Alright, but we are not going to be covering those specific cases, scenarios, case examples on this video, because that doesn't fall in the realm of reversals. That falls in the realm of fake breakouts, right? You see how that's a fake breakout? Okay, price seems like it's about to breach through, but immediately after it comes back down, and well, basically all the people who weren't, who were looking to trade the breakout there got actually faked out, and probably their stop losses got hit as price plummets in the other direction. That's why it's not a reversal, it's a fake breakout, and we are gonna leave that for a future video. All right. We could also apply the same thing to all these different formations. Actually, the railway tracks can be either a reversal formation, and it looks just like that, with price touching and bouncing right off that particular level of support and resistance, or it can take the shape of a railway tracks, as in a fake breakout, and then it will look something like this. Price seems like it's about to break through, and immediately after it pulls a 180-degree turn, and it turns all the way around in the opposite direction. That's again a fake breakout. Alright, a fake breakout formation, and again, we are going to be covering all that in a future video. Alright, let's go back to the hammer or pin bar. As you can see, I've colored the body of that candlestick, alright, the actual body of the candle in gray. That's because it doesn't matter whether it's a green or a red candle, alright. Since the body is so small, alright, the actual color of the body is just totally meaningless, alright. What's important, the key point, the key element in a pin bar is the long wick, alright. The longer the wick, the better, and the sharper it touches that level of resistance, support and resistance, also the better. The nature of the pin bar is basically heavy market rejection. All right, a pin bar signifies rejection of a key level of support and resistance. So, if you see price coming back to retest a level, in this case of resistance, again on this case example, and you see at the top of this up move, all right, price opening, giving us a small body, and then, like I say, a long wick, a long nose into the upside, and then coming back down just as sharply to close at the same, more or less at the same level. If this was a green bar, well, that would be the open, and that would be the close. If it was a red bar, that would be the open, and that would be the close. But at any rate, since the body is so small, as I was saying before, both the open and the close are going to be more or less at the same level. You can even get a cross, all right? A cross where the body is totally non-existent. Basically, the open and the close is literally lining out at the same level. But at any rate, like I said, what's important here is that price within this trading session, within this one day, since this is the daily chart, or within that week, if that was the weekly time frame, well, within this particular trading session, price has opened and closed at the same level, but from an intraday perspective, right? Again, intraday perspective, price came back up to touch that level, and it found such a heavy rejection that the market drove all the way around where it all started. Okay, the key element of that's why I say that the key element of a hammer formation is that long nose, which is got to be at least twice as long as the rest of the body and the small candle combined. Okay, a hammer needs to, I mean, it's the number one characteristic. Okay, long nose into one side and small body and a small lower wick into the other side. All right. So if you find this type of formation, all right, one individual candle with a long nose touching right to the pip, well, you can identify heavy rejection, heavy selling pressure around this area. That means that the bulls were strong enough to drive price all the way to these particular levels, but the sellers, the bears, right, the people building selling pressure or willing to click on their sell buttons, they were waiting at that particular level in volume enough, well, basically with enough orders to drive price back down in sharp momentum. All right. That usually indicates that that level of resistance is going to hold, and the next immediate move right after this particular hammer is going to be indeed to the downside. It's all about selling pressure or selling volume waiting at that particular level. So as soon as price touches that level, bang, it comes back down, and like I say, the most likely move in the upcoming day is going to be another red candle, all right, another red candle to the downside, all right, and this is where we are going to make our money. So how do you trade a pin bar or a hammer candlestick right off a level of support and resistance? In this case, resistance of the daily time frame. Well, first of all, you need the candle to close. All right, you cannot label any bar as a pin bar or as a railway tracks or as an outside bar, etc., unless the bar is finally closed. So since this is the daily time frame, you simply need to come back at the end of the day to your charts. Just sit for a second, all right, at the end of the day, at whatever time your trading platform closes the daily bars, and again wait for the bar to close. Obviously, if you were trading off the weekly time frame, you will need, you know, the week to come to an end, and you could sit at your trading station, for example, over the weekend or on Friday evening, you know, whenever the markets are closing for the week. All right, but at any rate, you need the individual candle to close. Then there are two ways of entering the trade. One is a conservative one, the other one is the aggressive way. Well, let's assume this is actually let me just color it. Okay, let's assume this is indeed a red candle, all right, and therefore that's the open of the day and that's the close for the day. Well, the aggressive way of entering the trade would be to click on your sell button as that bar closes. How is that? Well, because you are already recognizing the hammer formation, all right, banging onto that level of resistance and therefore signifying heavy rejection, and you know that statistically wise, chances are that the next move is going to be to the downside. So you don't really wait for the confirmation of this pin bar. As soon as the bar closes right there, and as soon as obviously the next bar opens, which obviously happens immediately after, well, that's where you click on your sell button. The conservative way is to wait for price to breach the low of that bar, all right, of that hammer formation, all right. So as soon as price begins to go down and to tick 5 pips, you know, my personal preference is just 5 pips below that low, all right, for that hammer, well, that's where I place my sell stop order. Okay, you simply tell your broker, I want to sell at this price, and once price opens, the next bar opens and begins to trail down, well, that's where your your broker executes your sell order, and therefore you are effectively shorting the market, searching to exploit, further moves to the downside. Again, conservative way, wait for the for price to break the low on the next candle, right? On the next candle, where for price to tick below 5 pips below the low of the hammer. The aggressive way, as the new bar opens up, right there is where you click on your sell button. Depends on how aggressive you are. I personally prefer the conservative way. I personally wait for price to confirm this bounce by breaking below that low of the hammer bar. All right. What about the stop loss? Again, two ways of dealing with the stop loss placement: the aggressive and the conservative way. The conservative way, simply place it 5 pips above the high of that the high of this pin bar, right there, 5 pips there. The aggressive way, well, you simply measure the entire distance from the low to the high of that pin bar, mark 50% of that distance, and place it 10 pips above that 50% level. All right. Again, the idea here is that once price begins to trail down, it's very unlikely that price will come back above that 50%. Okay, once the trade is triggered, it's very unlikely that price will actually come back up there. And if it does come back up there, chances are that this hammer formation is not going to work out at all, and price will simply keep on pushing to the upside. All right. So it depends again on how aggressive you are with your trading. I myself, I like to be conservative with my entries, but I like to be aggressive with my stop losses. So I like to enter 5 pips below the breakout of that hammer formation, but I like to place my stop loss 5 pips above that 50% of the entire range for that pin bar. Right? Very simple. Just measure the entire distance, mark the 50% level, and place the stop loss 50. Once you enter the trade, place your stop loss again 5 pips above that 50% level. Okay? What about the target level? Well, the target level is going to be dictated by the upcoming bars. All right. So what you do is you simply, again, assuming price triggers your entry as it should on the very next candle. Actually, let me just copy paste. Just give me a second. I'm gonna try to nail it down. Copy paste. All right, there we are. Let me bring that forward. Again, it doesn't matter, so I'm just gonna, doesn't matter the colors, I'm gonna just color it in gray again. So up on that pin bar, we get our entry bar, right? That's our entry right there. Our stop loss should be right there. Our first target, I always like to exit my trade in all my trades in a sequential manner, right? So what I do is at the close of this next bar, again at the close, you need the candle to close. So you come back at the end of the day, and whenever it closes, you simply close 50% of the trade. All right, just 50% of the trade, and then you trail your stop loss from your entry, either there if you were aggressive with your stop loss, or there if you were conservative. You simply trail it to if you are aggressive with your stop loss, from here you move it to break even. Okay, break even. If you are conservative with your stop loss, you move it from there to 5 pips above the high of your entry bar, okay, meaning that bar there. Again, it all depends on how you want to deal with your stop loss placements, aggressive or conservatively. Aggressively or conservatively, depends entirely up to you. I like to be aggressive with my stop loss, so I usually move it from there all the way to break even. So I simply trail it to break even to offset the risk on that trade altogether. And then what do I do with the remaining 50% of the trade? Well, in my experience, whenever you see a sharp bounce off a significant level of support and resistance, you usually see momentum enough in the opposite direction for 2 consecutive bars. Again, that's just my experience. So what I like to do is I wait for the second candle to close. All right, I close 50% of the trade there and another 50% of the trade there. Usually this second candle is not as profitable as the first one because the momentum, the down momentum is dying out by the time by the time this second bar pops up. So you usually see something like this. All right, oops, something like that. Nice move down immediately after the hammer is triggered. All right, and then also usually you get momentum for another down bar, but it's usually not as large as the first one. Anyway, to wrap it up, entry, stop loss. At the close of this first bar, you move your stop loss to break even, and then you exit the second portion of the trade at the close of the second bar. Regardless of this second bar is down or up, regardless of the color of this second bar, you simply close it at the close of the second bar. In the other hand, if you were conservative with your stop losses, that's your entry there, your stop loss is there. At the close, you exit 50%, you trail your stop loss up here, just 5 pips above that bar, all right? And then at this point, you close the remaining 50% of the trade, all right? That's basically how it works. That's basically how you trade the hammer or pin bar formation. Now, explaining the next two candle patterns are gonna be it's gonna be very quick, because even though the actual look of the patterns may be different from the hammer, well, the price behavior, the nature of the price market reaction of those levels of support and resistance is basically the same. All right, again, different shapes but equal price behavior. So like I said, this is going to take just a couple of minutes to go through. Okay, the railway tracks. Well, as you will see, the railway tracks is the same as a hammer formation that's been split into two different trading days, right? Or trading weeks if you are trading off the weekly chart. How is that? Well, that being the open for this particular day, then we have a nice rally up to the upside. Heavy reaction of that level, and on the second day price comes back down to close more or less at the same level where it all began, all right, where the first candle opened up. So if you blend these two candles, that being the open and that being the close, now that being the high and that being the low, what do we have? Well, we pretty much have the same thing as a pin bar, right? Again, the price formation is exactly the same thing. It's just taken 2 days to to develop as a whole, all right, as a pattern in itself. So it is it's just a twin candle formation. One of the candles is green, retesting that level. The next one is red, pretty much equal in size, both of the candles, with the same length as per the body of the individual candles, etc., etc. Again, same thing as a pin bar, just splitting the price, the price action into different daily bars or weekly bars. How do you trade that? Well, same thing as we do with the pin bar. In fact, I can, oops, sorry about that, just give me a second. If I can select everything off and move it all the way down here, it's pretty much the same thing. Entry just below the low of that red candle, of the second one, all right, maybe 5 pips below. Stop loss, if you are conservative, you place it up there. If you are aggressive, 50% of this second candle and up there. Exit 50% at the close of the trigger bar, which is this one there, and then you leave the second portion of the trade run to the close of the second bar. Again, pretty much the same thing as with the pin bar. And the same holds true for the outside bar. The outside bar is, well, it's pretty much a railway tracks where the up move didn't quite carry that much of a momentum, all right? As price was driving us, was moving up to retest that particular level, it lost momentum in anticipation of the upcoming downward bias. All right, the selling pressure was already building up before price came actually to touch that particular level. So as a result, what do we get? The second candle of the outside bar totally totally engulfing the previous one, right? This is the up move. It's already beginning to lose momentum as price gets closer and closer and closer to this level of support and resistance, because the sellers are beginning already to click on their respective sell buttons, and therefore this up move is not quite as strong as in this one. All right, so therefore, as a consequence, the down move, the second bar, the second portion of this candle is larger and engulfs, as you can see, the low is lower than the previous bar's low, and the high is higher than the previous bar's high. All right, so again, the selling pressure appears before, or shows up before, in this pattern than in this one, but again, the nature is exactly the same. The nature of the candle is in itself is exactly the same, so you would trade it absolutely in the same way. All right. Okay, so we've covered the three conservative patterns, the three conservative reversal formations. It's time to move on into the aggressive ones. Maybe aggressive is not the right term I am looking for here, but I would certainly say that they do carry a lower degree of quality as a trading signal. In fact, I am pretty sure that if you trade 100 times either the pin bar or the railway tracks or the outside bar, well, after those 100 trades, you will score a better win-loss ratio out of these setups than if you trade 100 times either the inside bar or the spinning top or doji. Is basically the same thing. All right. I mean, the spinning top and or doji is exactly the same thing. So what I'm getting down to is that you will indeed suffer from a little bit of a lower win-loss ratio out of 100 trades out of these two. How is that? What's the reason behind that? Well, the reason behind that is because we don't quite see, in these two patterns, we don't quite see the heavy market rejection we saw on the previous patterns. As you can see, and this is something that I forgot to mention before, so please pay a little bit of attention here. As you can see on the railway tracks, the outside bar, the pin bar, the name of the game, the trick here, is that heavy rejection we got as price reaches that level of resistance, right? Whenever you see heavy rejection, it means that there is plenty of selling volume waiting at that particular level, right? Well, as a result, what you get is on the second candle, meaning on the reaction candle, this is the approach candle and this is the reaction candle, right? Well, on that reaction candle, what you see is usually a long candle with a full body or a long body on that second candle. All right. What I'm talking about here is that, well, basically the size of the body in that candle is at least 80% of the total length of the candle as a whole. All right, the majority of the candle is made up by the candle, right? And whenever that happens, that means that price is moving in trading volume, is moving in momentum, because there is no hesitation within this trading session, within that daily or weekly bar. The sellers, the bears, have been in total control of the price action, because as you can see, there is very little hesitation both to the upside and to the downside, right? Very little wicks or very short wicks on that particular candle. Most of the price action is made up by the body, and therefore it means that this down move is happening in volume. Well, we don't quite get that there. The rejection of that level is not quite as spectacular as we were expecting to see. All right, here and there, we don't quite get that heavy rejection, and therefore Well, that means that there are not that many sellers waiting to click on their respective sell buttons as price hits that level. And you know what they say, guys? Usually the best trading signals happen whenever you see trading volume driving price in your direction. If there is no volume, pushing the trade, pushing price along, obviously in your direction, or hopefully in your direction, beware, right? You want the market as a whole to agree on into one given direction. So as a result, the upcoming next two bars are going to happen rather fast, and obviously to the downside if you are trading a bounce of a level of resistance. Okay, so in these particular cases you don't get that heavy rejection, and therefore you are not that sure to see you are not ensured to see that heavy momentum move to the downside as a result in the upcoming next two candles. All right. So to wrap it up, these last two patterns, all right, inside bars and spinning tops or dojis, what they represent is market confusion. All right. It's not market rejection. It's not market rejection, guys. It's market confusion. Here we get a full bounce. Here we simply see price stalling right below that level. Okay, so again, market confusion. Here we do know that price wants to turn around. In here, price doesn't know whether to break through or to turn around. It's still not giving us that directional bias we were mentioning before. Remember, on a previous video we were talking about some of the key principles in support and resistance trading, and one of them is that you need a bias. Okay, you need the price to hint the next market move. All right. Before triggering the trade. Well, we don't get that. Price is not giving us any clue yet on these last two candles, and therefore, as I was mentioning before, the quality of those trading setups is just lower. All right. So on the inside bar, what we usually get, as by definition, is a high lower than the previous bar's high, and a low higher than the previous bar's So the previous bar is totally engulfing the current bar. And on a spinning top, what we have is just a small candle. By the way, a spinning top is a candle with a small body and short wicks on any direction, both up or down. On a doji, what we have is just a small cross. All right, basically the open and the close is lining out at the exact level, but at any rate, the price nature of both of them, spinning tops or dojis, is exactly the same thing. All right. So again, market confusion as opposed to market rejection. So how do you trade market confusion just below a level of resistance? Well, if you truly are a conservative trader, your best course of action is to simply not trade them at all. Whenever you see these price patterns right off a level of support and resistance, it's just best to not take those trades, those signals, and to simply stick to the high quality ones. Now, in the other hand, if you are a little bit more adventurous, so to speak, you are a little bit more of a cowboy with your trading, well, yes, you can still take those trades, but you should be managing your risk more closely, or rather you should be controlling your risk a little bit more closely. How do you do that? Well, you simply cut down on your usual trading size. If your usual trading size on a standard trading opportunities is, I don't know, 2 lots, for example, right? Well, your best bet is to trade these signals just with one lot, all right? Or whatever whatever you trade, simply cut it down to half, all right? Again, to control your risk, since undeniably your win-loss ratio is going to drop down, all right? You're gonna score poorer results in the long term. That doesn't mean that, again, in the long term they cannot be profitable. because they can indeed be profitable, but you don't want to risk or to bet as much as you do with these high quality setups where your win-loss ratio remains rather high in the long run. Alright, so simply cut down your trading size by half. Alright, let's cut down on the fluff and let's get down into the specifics. How do you enter your trades on inside bars and dojis? Where do you place your stop loss? Where do you place your profit taking levels, etc., etc.? Well, as far as the stop loss, in these cases we were mentioning that you can simply mark the 50% range and place your stop loss 5 pips above that level, right? You remember that? Well, you can't do that in inside bars or dojis. How is that? Well, because this second bar is usually much smaller than these ones here, and therefore you may not quite have enough room. If you place your stop loss just at the 50% or 5 pips above the 50% range, maybe a little bit too close to your entry level, which by the way your entry level is still going to be placed 5 pips below the low, right, of those candles. Well, that may be a little bit, if you place it there, just a little bit too close. So I am afraid you'll have to simply, well, place it above that, above the high of that, either the inside bar, right, or the spinning top. Again, 5 pips, usually enough. Your entry, as usual, 5 pips below that level. So let me carry all this thing on here. All right. So if that's your entry, that would be your stop loss. Now, profit taking levels, same thing. You wait for the candle to close, but you're not going to close 50% of the trade there. You're going to close 66% of the trade. You need to be a little bit more aggressive here with your target policies, since you are not getting that heavy market rejection, right? You're simply getting a little bit of market confusion. You want to exit or to cash out your the majority of your trade. 66%, 60%, 70%, that's all reasonable, alright? I will let you decide that. I personally simply exit 2/3 of the trade, but again, anywhere between 60 or 70, the majority of the trade, at the end of the day, it is a good idea to close that majority of the trade as soon as possible, alright? So at the close of your trigger candle, the candle that triggers you into the trade, you want to close indeed the majority of the trade, and then, well, as usual, trail your stop loss to break even, and, well, hope, pray, or expect, wishfully expect price to keep on pushing down in order to, make some further profits on that second 33% of, well, actually, sorry, 34% of the trade, or the remaining second portion of the trade, like I say, expecting further profits. But my advice, at any rate, regardless of the actual percentage you want to close out at that level, make it to be significant, 60, 75, 60, 66, 70, whatever, because again, you are not carrying, this position is not carrying that much of a down momentum, all right? These bounces are not showing that much selling pressure on this rejection candle, and therefore the consequent down move, more often than not, is not going to be as significant as in here, all right? And therefore you may just have one chance to make profits out of this move. Alright, so do not be surprised if this first trigger bar is just going to be the only profits you get out of that move, and to have this second candle, maybe actually I can push this up a little bit and color it in either green or gray. Alright, at any rate, do not be surprised if this second candle doesn't quite give you any profit whatsoever. That's why you want to cash out the majority of your trade on the first move. Okay, that's gonna be the main move on that trade. All right, either for inside bars or for spinning tops. Now, at this point, there is something that I like to cough out of my chest, since you're probably wondering, well, why do we even bother trading these two setups? I mean, if we can just get one single move, profitable move, statistically wise, out of these reversal patterns. I mean, is it really worth it? Well, the thing is that you've got to remember that at the end of the day, price is still respecting that daily level of resistance. All right, that key level key decision taking level. Well, the market is still respecting. At no point we've gotten a breakout yet. All right, and well, until we get that breakout, we must assume that that level of resistance is still in place. All right, that's the thinking here. As long as we don't get that breakout, that level is in place. All right, and as long as price or the market as a whole is bringing this approach move down to a halt, right, down to a stop, and from there, I mean, sure, we may not get rejection, right? We may not get rejection. Instead, we get confusion. But even within that confusion, the selling pressure is enough to bring this approach move to a stop, and as a result, having that level to being respected by the market and not simply not breached, at least yet. All right, so again, from a statistical point of view, chances are that we may get some temporary down move. All right, even if it's just by one candle. Again, make some profits there, trail your stop loss to break even, and from there, hey, what does it matter whether price comes up or down? At least, again, your stop loss is secure to break even, and that key decision taking level is still in place. All right. That's why, even though these two setups are not as ideal as these ones, well, they are still tradable. All right, one final note that one final piece of information I want to drop in, I want to throw in as far as reversals goes. Since we are trading rejection, right? Since we are trading momentum bounces of levels of support and resistance, especially on these three patterns here on the left, you want to have your entry triggered in the bar immediately after the reversal formation. That means that the next consecutive bar, it should be, actually, let me just pick all this thing here and bring it down here. The next consecutive bar upon the reversal formation in itself must be the candle that triggers your entry. All right, must be the candle that actually gets you in the trade. So you don't want stuff like this. You don't want stuff like this. You don't want to get the reversal formation, then a hesitation bar not quite triggering you into the trade, and then getting your entry, because that means that this bounce is kind of losing momentum with that hesitation bar there. All right, the color of this confusion bar is meaningless. It doesn't matter. You want to see, what's important is that you are not quite seeing that momentum right away. All right. As a general rule of the thumb, I usually give my entry 1 bar or 2 bars at the most. That means that either I get triggered on the bar immediately after the reversal formation in itself, or at the very latest, the second candle after that reversal, or I simply cancel the pattern altogether. If I had placed a sell stop order 5 pips below the low of that hammer, if I don't get my entry by the first or second candle after that reversal formation, I simply cancel that sell stop order, because then it means that the rejection is just not happening in momentum. It's taking way too long, and that's not what I want to see. I want to see, again, momentum bounces. All right, obviously this pretty much applies to both hammers, railway tracks, okay, and outside bars. All right, whenever you see inside bars, and especially spinning tops dojis, you are more likely to see this type of formation. Again, oops, I am losing my wicks along the way there. Just give me a second here, guys, just to fix things up. All right, That's what happens when you're not totally familiar with technology and the latest softwares. Anyway, since these patterns are not quite happening by definition in momentum, remember that this is a confusion. Reversal formation is not a rejection formation. All right. So do not be surprised if you see a little bit of a sandwich bar in there, sandwiched in between the reversal pattern and the actual entry bar. Again, that happens quite often, especially with spinning tops. Do not be surprised again if you see a few spinning tops in a row and then bang, the momentum bar, the actual trigger bar. There is nothing you can do about it. All right, there's not much you can do about it. Please remember that these are lower quality signals, and therefore your entries will not happen in as much as momentum as with these three ones. All right, that's why I said before, if you are totally a conservative trader, you may want to simply cancel on these ones, because again, you may see those sandwich bars in between the reversal and the actual trigger bar. In fact, you may see, if you are, for example, trading inside bars, you may see few inside bars in a row. Let me take this one off. And something like this. When approaching candle momentum to the upside, price respects that level of support and resistance, then it gives us an inside bar, and then it gives us yet another inside bar of the inside bar. That means that actually signifies, well, the market is taking its time to make up its mind as per the next move. All right, and in fact, if you zoom into the shorter time frames, what you will probably see is a triangular formation. All right, you see, if you link up the lows for the individual candles and the high for the individual candles, you will basically see price compressing and compressing from an intraday point of view. All right, basically hesitation, guys, hesitation. Again, that shouldn't happen. You don't want that to happen in these high quality setups, but unfortunately you will see it happening quite often on these ones here. All right, so to sum it up, if your entry gets triggered with the in the bar immediately following the reversal formations, that's the ideal situation. If you get, in the other hand, if you get instead one sandwich bar, you don't quite get triggered on the first bar, then you need to wait for the second bar. That's okay-ish as well, not ideal, but it's still okay. However, finally, if you simply need to wait for or you get two sandwich bars in a row, don't take that trade anymore. All right, just even if it gets triggered eventually, that's not the trade you want to take, because this bounce is not really happening in that much momentum, and therefore that's not the ideal situation. Okay, that's not what the type of market condition you want to trade. You want to see heavy trading volume there, driving price down. Two sandwich bars, way too much confusion, way too much hesitation. You want to stay away from that. All right. Okay, folks, that's about it as far as the theory goes. Now we're going to be digging into actual charts, and I'm going to show you some actual forex charts where we will be reviewing plenty of reversal formations. All right, I'll be waiting for you at the next video.